Every month when I get paid, I add to my investments. In this video, I'll walk you through the accounts I use, the investments I made, and why I chose them. If you'd like to stay updated on my investments and portfolio performance, make sure to hit subscribe. Now, let's get into it. The approach that I take when it comes to investing is long-term. My plan is to stay invested for decades, essentially until I either decide to stop working or feel like I've built enough wealth to partially or fully retire. Each month I contribute to two types of accounts that are tax advantaged in the UK. The first one is the self-invested personal pension, also known as SIP. This is my personal pension account and contributions come directly from my business, as I'm self-employed and co-own a limited company. Unlike a workplace pension, I have full control over this account. But because it's a pension, I won't be able to access the money until I'm around 60 years old, which is quite a while from now. This is why the second account I use is a stocks and shares ISA. This allows me to invest without having to pay tax on any gains or income and crucially doesn't lock my money away, which is perfect for medium or long-term goals. When I started investing, I focused entirely on individual stocks. It was exciting, but also time-consuming and very risky. Over time, I've shifted to index funds, which require less maintenance and spread your risk among hundreds, if not thousands of companies. Of course, investing will always involve some risk, right? But funds, particularly index funds, are usually less risky than individual stocks. Currently, my SIP is 100% invested in index funds. For my ISA, about 60% is in index funds and 40% in individual stocks. For individual stocks, I target high-quality, fast-growing companies and aim to hold them for at least 3 years. January was a hectic month for me. The post-Christmas return to routine left me with very little time to research individual stocks. As a result, I decided to focus entirely on index funds for my investments this month. If you're new to index funds, they're essentially baskets of stocks that mirror the performance of a specific part of the market by replicating what's known as a stock market index. One of the most famous examples is the S&P 500, which tracks 500 medium and large US companies. Investing in index funds is often described as buying the market. Instead of trying to pick the best performing individual stocks, you're spreading your risk across many companies. Historically, index funds have delivered strong returns and have often outperformed actively managed funds, which are run by experts who handpick stocks. Let's start with the investments I made in my stocks and shares ISA this month. First, I invested £150 into the Invesco EQQQ NASDAQ 100 ETF, ticker symbol EQQQ. An ETF just stands for Exchange Traded Fund. This ETF tracks the performance of the 100 largest non-financial companies listed on the NASDAQ stock exchange, which is a stock exchange in the United States that tends to be more weighted towards technology companies. Think of it as a snapshot of the US tech sector. I actually had been considering adding to my Alphabet position this month, Alphabet being the parent of Google and YouTube. Alphabet is already part of my portfolio, but I didn't have time to research its valuation. Instead, I chose the NASDAQ 100 ETF. Conveniently, Alphabet makes up 5.7% of the index, so about £8.55 of my investment still went into Alphabet stock, albeit indirectly. NASDAQ 100 index funds are generally seen as higher risk but potentially higher reward because of the focus on US tech companies. I'm personally happy with taking on that additional risk for 3 reasons. 1, I have decades of investing ahead of me, so I'm happy to ride the ups and downs of these investments. 2, I believe that technology companies tend to drive economic growth, and the US arguably has the strongest economy in the world, so it's an area I'm happy to focus on. And 3, if I hadn't invested in this index fund, I probably would have invested in a technology stock instead, probably Alphabet. So on balance, this investment is less risky than the alternative that I might have made, because I've spread my risk across 100 companies instead of 1. The second and final investment I made through my stocks and shares ISA is one that I make every single month. I invested £600 into my global pie. Trading212, the investment platform that I use, allows you to create a custom collection of stocks and ETFs, and they call these things pies. I called my custom pie Global Pie, which you'll see in a minute that is not a very creative name. By the way, if you want to open an account with Trading212, you can use promo code SNSBONUS to get free fractional shares up to £100 when you join. This is a commissionable link, which means that we get a small payment if you use our code. And I'll leave a link to the terms and conditions in the description of this video. Anyway, my global pie is made up of 2 global ETFs. 92.5% of the pie is invested in the Invesco FTSE All World ETF, ticker symbol FTWG, which covers medium and large companies worldwide. The remaining 7.5% of the pie is invested in the iShares MSCI World Small Cap ETF, ticker symbol WLDS, which covers small companies around the world. By investing in this one pie, I get instant diversification across thousands of small, medium, and large companies across the globe. It's also a passive investment approach mirroring the performance of the global stock market. One common question I get online is, why not just invest in the S&P 500 since it outperforms global funds, and global funds are already 60% US stocks? Well, it's true that the S&P 500 has performed very well, and the US stock market currently accounts for 60% of the global market due to its many dominant companies. But who knows what will happen in the next 10, 20, or 30 years, right? Take Japan in the 1980s, for example. Its stock market boomed thanks to economic growth and low interest rates, reaching a peak in 1989, where the Nikkei made up 45% of the global market, more than the US at the time. However, rising inflation and interest rates caused a crash. This, combined with the deflation that ensued, led to a prolonged economic downturn. And today, Japan represents just 6% of the global stock market. I don't think the US will follow the same path, as it has a stronger and more resilient economy. However, this history shows why diversification is key. Global index funds automatically adapt to changes. If one market declines, the fund reduces its exposure and increases focus on stronger markets. For example, a global fund in 1989 would have started heavily invested in Japanese stocks, but shifted over time as Japan's market fell and others, like the US, rose. This self-cleansing nature ensures your investments always align with current market strengths. That's why global funds form the largest part of my portfolio and why I topped up my global pie with £600 this month. Let's now quickly go through the investment that I made within my SIP, which is with Vanguard. Within my SIP, I only invest in one fund, the Vanguard FTSE Global All Cap Index Fund. This is also a global index fund that covers thousands of small, medium, and large companies worldwide. But it is slightly different from the Invesco FTSE All World ETF in my ISA. While the Invesco ETF focuses on medium and large companies, the Vanguard fund has small companies as well. This fund is actually not available on Trading 212 because it is a mutual fund. Trading 212 only has exchange-traded funds. And this is why I have to make my global pie on Trading 212 and I add the iShares MSCI World Small Cap ETF in order to get that exposure to small companies too. I still prefer Trading 212 for my ISA though, because it has lower fees than Vanguard. That's a wrap on my investments for this month. If you're curious, Jamie, my fiance, and the other half of this channel posted his monthly investments last week, so be sure to check that out. And if you'd like to follow along with our investing journeys, don't forget to subscribe. Thanks for watching, and I'll see you next time.